Just like you and I, banks also borrow money when they need it and invest any extra cash they have to grow their wealth. It's a constant cycle of borrowing and investing to stay profitable. Now, banks, like any other business, exist to make a profit. If their operating costs go up, their profits take a hit. But here's the thing, banks rarely absorb these extra costs themselves. Instead, they pass them down to people like you and I. Hey everyone, in this video, I want to talk about how Canadian mortgages work. In 2023, rising mortgage rates had a major impact on people's lives. Homeowners and buyers found themselves in a difficult situation with increasing inflation, higher interest rates, and housing becoming less affordable. As families tried to make sense of the sudden and constant pace of these changes, one question kept coming up in households across the country. To understand the answer, we need to go back to the basics and take a closer look at how mortgage rates are determined and the forces that drove their dramatic increase. So, what is an interest rate? Interest rates are the percentage charged by a lender when you borrow money, or the percentage earned when you save or invest money. Think of it as the cost for borrowing or the reward for lending. For example, if you borrow $1,000 with a 5% annual interest rate, you'll pay an extra $50 over the year, making the total $1,050. Similarly, if you save $1,000 in a bank account with a 5% interest rate, you'll earn $50 after a year. So when you borrow money, the interest rate determines how much extra you'll pay in addition to the principal amount borrowed. But how does this impact you? When interest rates are high, borrowing money becomes more expensive. This affects things like mortgages, car loans, credit cards, and personal loans, making it harder for people to afford large purchases like homes and vehicles. High interest rates mean families have to spend more of their income on paying back loans, leaving less money for everyday expenses or savings. We saw this happen in Canada during 2022 and 2023. The housing market slowed down because fewer people could afford to buy homes. Demand dropped, prices fell, and overall activity in the housing market decreased. The data shows us that housing activity in Canada dropped significantly. Many potential buyers could no longer afford homes because of the higher mortgage rates, and sellers were reluctant to list their properties, worried about lower demand and offers that didn't meet their expectations. With both fixed and variable mortgage rates reaching their highest levels in over a decade, the housing market saw one of its biggest slowdowns in years. Affordability became a major issue, making it harder for buyers and sellers to participate in the market. Now, before talking about what a mortgage is made of, let's just quickly understand what a mortgage is. A mortgage is a special type of loan designed specifically for buying or refinancing a home or real estate. It allows people like you and I to purchase real estate without needing to pay the entire amount upfront. Instead, you borrow the money and pay it back over time in smaller installments. When you're ready to buy a home and you go to the bank for a mortgage, they'll give you a few options to choose from. Now, when you pick one of the options, you'll need to make a couple of important decisions. Let me walk you through what those decisions are. First, they'll ask you to choose the type of interest rate you want. Do you want a fixed interest rate where your rate stays the same for the term, or would you prefer a variable interest rate which can go up or down depending on the market? Next, you'll need to decide on the term of your mortgage. This is the length of time your current mortgage agreement, including your interest rate, will last. Most terms are between 1 and 5 years. Finally, you'll choose the amortization period, which is the total time you'll take to fully pay off your mortgage. For most people in Canada, this is usually around 25 years. Now, if any of this sounds a little confusing, don't worry, because we'll break it all down step by step so it makes sense. Alright, let's take a closer look at term and amortization to understand them better. Amortization is the total amount of time it will take for you to completely pay off your mortgage. In Canada, the typical amortization period is about 25 years. And here's how it works. A shorter amortization period means you'll pay less interest overall, but your monthly payments will be higher. A longer amortization period means your monthly payments will be smaller, but you'll end up paying more interest over the life of the loan. In this example, we see that for a 25-year amortization, your monthly mortgage turns out to be around $5,300, with the total interest amounting to $594,000. Now look at the 30-year amortization example. We see that the monthly goes down to $4,800, but notice how your total interest paid will increase to $732,000. Now let's talk about the term of your mortgage. The term is the length of time your current mortgage agreement is in effect. This includes your interest rate and other terms agreed on with the bank. At the end of the term, which is usually between 1 and 5 years, you'll need to renegotiate your mortgage. This means revisiting your interest rate and possibly other conditions. based on the market at that time. It is important to understand how these two work together because they impact how much you pay and how quickly you can become mortgage free. If you're wondering how this all works together, let me break it down for you with a simple example. Imagine you have a mortgage that will take 20 years to fully pay off. This 20-year period is called the amortization of your mortgage. But here's the key difference. In Canada, you cannot lock in your interest rate or other terms for the full 20 years. Instead, you'll need to renegotiate your rate and terms with the bank every few years. The shorter period, usually between 1 and 5 years, is what we call the term of your mortgage. Let's say you choose a 5-year term with an interest rate of 5%. At the end of those 5 years, you'll need to refinance the remaining balance of your mortgage. The bank will offer you new terms and a new interest rate based on the market conditions at that time. Think of it like a reset or renegotiation that happens every term until your mortgage is fully paid off. This is quite different from how things work in the US, where you can lock in the same rate and terms for the entire amortization period. So for 20 years in this example. But that's not how it works in Canada, which is why understanding term and amortization becomes so important. Now that we've covered term and amortization, let's move on to one of the most important parts of a mortgage, the interest rate. The interest rate or mortgage rate is probably the most talked about part of any mortgage. In fact, people often focus on it even more than the term itself. Mortgage rates come in different types, and the type you choose can have a big impact on your monthly payments, how much interest you'll pay over the life of the loan, and how flexible your mortgage will be. Let's dive into what that means. Let's start by talking about variable rate mortgages. Variable rates are the interest rates that can change at certain times depending on Bank of Canada's policy decisions. This means your monthly payment can go up or down over time, which makes them less predictable and less stable compared to fixed rates. However, variable rates are usually lower than fixed rates for the same term. Why? Because they account for the possibility that the rate might increase in the future. So while you might save money initially, there's always the risk that your payments could rise if the rates go up. But to really understand how variable rates are determined, we need to take a step back and start at the beginning. All major financial and monetary decisions that impact a country's economy are controlled by its central bank. In Canada, that's the Bank of Canada. Now, just like you and I, banks also borrow money when they need it and invest any extra cash they have to grow their wealth. It's a constant cycle of borrowing and investing to stay profitable. Pro tip: if you're not already investing your extra cash to grow your wealth, start as soon as you can. It's one of the smartest moves you can make for your financial future. Alright, let's get back to it. The Bank of Canada holds 8 meetings a year where they announce changes to something called the overnight lending rate. This rate is super important because it's the interest rate that banks use when they borrow money from each other overnight. Why do they do this? Well, banks deal with money all day. People like you and I deposit and withdraw money from our accounts. So at the end of each day, banks look at how much cash they have left on their books. So you can think of Bank of Canada as a kind of financial watchdog. Its job is to make sure the system stays stable and that banks always have enough money on hand to operate. That's why Bank of Canada requires every bank to keep a minimum amount of cash in their accounts every single day. It's a rule to ensure the banking system runs smoothly. To make sure they meet the minimum cash requirements and have enough money to operate the next day, banks often borrow funds overnight from other banks. The interest rate they pay for this borrowing is controlled by, you guessed it, the Bank of Canada. From 2022 to 2024, Bank of Canada raised their target overnight lending rate from 0.5% to almost 5%. When the Bank of Canada announces an increase in the overnight lending rate, it becomes more expensive for banks to operate. Now, banks, like any other business, exist to make a profit. If their operating costs go up, their profits take a hit. But here's the thing, banks rarely absorb these extra costs themselves. Instead, they pass them down to people like you and I. So how do they do that? Banks use something called the prime rate. The prime rate is a benchmark interest rate that banks use to set the rates for various loans, including variable rate mortgages, lines of credit, and interest rate on credit cards. But where does the prime rate come from? Banks calculate the prime rate by adding a risk spread to the overnight lending rate set by the Bank of Canada. This spread accounts for the risks and costs involved in lending money to customers, which is why prime rate is always a bit higher than the overnight rate. In simple terms, when the overnight rate goes up, so does the prime rate, which means a higher interest rate on loans and mortgages for consumers. Take a look at this data. It shows how Canada's commercial banks adjusted to changes in the overnight lending rate over the last 2 years. To determine their prime rate, the banks added a spread of 2.2% to the overnight lending rate. This increase in the prime rate directly impacted the interest rates on various financial products, including your mortgage. Now, why does this matter? Because the interest rate for your mortgage, especially for variable rate mortgages, is often based on the prime rate. So when banks raise the prime rate, your mortgage rate and potentially your monthly payments go up as well. This is a clear example of how changes in the overnight rate trickle down to affect individual borrowers like you and I. Now let's break down the relationship between the prime rate and the variable mortgage rates. A variable mortgage rate is typically tied to the prime rate and is expressed as prime plus or prime minus. Here's what that means. Your mortgage interest rate could be slightly higher or lower than the prime rate. For example, if the prime rate is 4%, your variable rate might be prime plus 0.25%, which would be 4.25%, or prime minus 0.25%, which would be 3.75%. Now here's how this impacts you. When the prime rate goes up, your variable mortgage rate increases, meaning your monthly payments, including the portion going towards the interest of your mortgage, will also increase. When the prime rate goes down, your mortgage rate decreases, which reduces the interest portion of your payments and may lower your overall monthly payment. This flexibility can save you money when rates drop, but it also means your payments can increase when the rates rise, which is why variable rates are less predictable than fixed rates. The interest rate you receive on your mortgage depends on several factors, including the type of loan you're seeking, your credit score, and your overall financial profile. Historically, 5-year variable mortgage rates in Canada have often been offered at a discount to the prime rate. This discount can vary based on factors such as market competition, customer acquisition strategies, economic conditions, and other incentives provided by the banks. The takeaway here is simple. Variable mortgage rates are shaped by a dynamic mix of factors: central bank policies, lenders' prime rates, and market forces. For example, from March 2022 to late 2023, the Bank of Canada raised its rate from 0.5 to 5%. In response, the prime rate jumped from 2.7% to 7.2%, directly impacting mortgage rates and increasing cost for borrowers. And now that we've explored how variable rates work, let's shift our focus to the other option banks offer: fixed mortgage rates. This is a completely different approach to how your mortgage interest rate is determined, so let's break it down. A fixed mortgage rate works like this. For example, you agree to pay a 4% interest rate on your loan for the next 5 years. This means your monthly payments will stay the same throughout that 5-year term, giving you stability and predictability. However, the stability comes at a cost. You won't benefit if rates drop during that time. Unlike variable rates, fixed rates are influenced by longer-term financial market conditions, such as bond yields, rather than short-term changes like Bank of Canada's overnight rate. This makes fixed rates more stable but less flexible in response to market changes. Fixed mortgage rates are closely linked to the yields of Government of Canada bonds, like the 5-year bonds for 5-year fixed mortgage rates. But why does this relation exist? Let's break it down. When you buy a 5-year government bond with a 4% yield, you're essentially lending money to the government for 5 years and earning a guaranteed 4% annual return. This return is considered risk-free because government bonds are backed by Canadian government, making them one of the safest investments. The 4% yield on these bonds acts as the baseline cost of borrowing for the same time frame, 5 years in this case. Now, banks have a choice. They can lend their money to the government and earn this guaranteed 4% return. But when banks lend money to you and I as a fixed mortgage, the risk is higher than lending to the government. To account for this added risk, banks charge you a higher interest rate than the bond yield. This difference covers risks like potential default, operational costs, and the profit margin they need to make the loan worthwhile. In short, bond yields set the minimum return banks expect for a specific term. Your fixed mortgage rate is higher because it includes the risks and costs of lending to individuals rather than the government. This is why fixed mortgage rates follow the movement of bond yields so closely. If bond yields go up, fixed mortgage rates tend to rise, and if bond yields drop, fixed rates often decrease too. Now, government bonds are a type of financial product similar to stocks. Just like stocks, bonds are bought and sold in financial markets, and their prices fluctuate constantly based on supply and demand. Here's the interesting part. When the price of a bond changes, it also changes the return investors earn from it. This is important because the benchmark bond yield keeps shifting as the bond market reacts to things like the economy, investor confidence, and other market factors. To put it simply, when bond prices go up, yields go down. When bond prices drop, yields go up. And since these yields influence fixed mortgage rates, the rates offered by banks will adjust accordingly. It's all connected. Now in this section, I'm going to talk about why bond prices and yields move in opposite directions. If this feels a bit too technical, don't worry. You can skip ahead to the next section, where I will cover more practical examples. So bonds pay a fixed amount of interest called a coupon. This helps in determining the yield or return of the bond. For example, let's say a bond pays $50 a year, and its original value is $1,000. Now, if the bond price goes up to $1,200, that $50 is now a smaller percentage of the price, so the yield or the return you earn goes down. On the other hand, if the bond's price drops to $800, that $50 becomes a larger percentage of the price, so the yield goes up. Why does this happen? One big reason is inflation. When inflation rises, new bonds are issued with higher interest rates to match the higher costs. Older bonds with lower rates become less attractive. To sell those older bonds, sellers have to lower the price. When the price drops, the yield goes up, making it appealing to buyers. This becomes important because banks look at bond yields to figure out the cost of borrowing money for fixed rate mortgages. So now that we understand how bond yields affect mortgage rates, let's take a closer look at what happens in the real world with 5-year fixed mortgage rates. If you look at the average historical rates, you'll notice something important. The difference between the bond yields and the mortgage rates, called the spread, isn't always the same. The spread can change depending on what's happening in the economy. If the economy is uncertain or unstable, the spread tends to widen, which pushes mortgage rates higher. If things are more stable, the spread narrows, leading to lower mortgage rates. This is why you might see mortgage rates sometimes rise or fall separate from bond yields. The spread reflects market risks and costs that lenders account for when offering fixed rate mortgages. It's another piece of the puzzle that affects what you pay. Now let's talk about how fixed rates and variable rates compare. Under normal conditions, fixed mortgage rates are higher than variable rates. Why? Because fixed rates give borrowers stability and predictability over the term of the loan. Lenders charge a bit more for the stability to cover the risk of locking in a rate for a longer period. On the other hand, variable rates are usually lower because borrowers take on the risk that rates might go up. Lenders charge less for variable rates to make them attractive to borrowers. But there are exceptions to this general rule. When inflation is high and the central bank raises interest rates aggressively to control it, the prime rate increases. This makes variable rates more expensive. Meanwhile, fixed rates, which are tied to the longer term bond yields, may stay lower if inflation expectations are managed. When markets expect rate cuts in the future, bond yields can drop, pulling fixed rates down. However, variable rates may remain high for a while because they are based on the current prime rate, not future expectations. In 2022 to 2023, Canada's central bank raised interest rates quickly to fight inflation. This caused variable rates to increase sharply, making them much more expensive for borrowers. Meanwhile, fixed rates, which are tied to the bond yields, stayed relatively stable. As a result, fixed rate mortgages became a more attractive option for many borrowers during this time. Alright. Time for a bonus tip. If you're stuck deciding between various mortgage options and need a quick, reliable way to compare them, then check out this mortgage comparison calculator. It's an absolute game changer for making smart mortgage decisions. Here's why I love using this tool. It lets you input all the key details like loan amount, interest rates, term length, and amortization period. It then generates a clear picture of your options. It breaks down everything for you: monthly payments, total interest cost, and even how much of your balance will still be left at the end of the term. And if you're leaning towards a variable rate, this is amazing because you can simulate potential rate changes to see how rising or falling interest rates could impact your overall cost. It takes all the guesswork out of the equation. If you found this video useful, feel free to share it with someone who's navigating the mortgage process. It could give them the clarity they need. Thanks for listening, and I'll catch you in the next one.